Hi, my name's Debra. I'm with the Property Frontline.
Hi, I'm Ken from Avvora Finance.
And I'm John Gilmovich from Real Property Manager, and welcome to another session of Property Mythbusters. Property Mythbusters is all about debunking some of the myths and contradictions and misleading information in the property buying and investing space. And we are privileged to have a very special guest with us today and to discuss the benefits of depreciation schedules is Brad Beer from BMT and Associates, which is a leading firm for depreciation schedules in residential and commercial property. It's a national-based company with representatives all around Australia, and Brad's going to have a chat with us about some of the benefits, and we hopefully debunk some myths around some misconceptions around getting a depreciation schedule and depreciation itself on investment property. So I'm going to hand it over to Brad, and welcome this morning, Brad.
Thanks, guys. Great to be here. Always like to debunk a few myths about property depreciation. It's been a good 20 years of my life doing that.
Yeah.
Good.
Nice.
So, Brad, can you tell us a little bit about what you do?
Yeah, sure. Look, funnily enough, you talk depreciation, people look at you funny sometimes. I'm actually a quantity surveyor, someone who estimates construction costs of buildings. And at BMT, we focus on this depreciation part, which is we look at a house and we identify how much depreciation is able to be claimed. Depreciation is a simple thing that, like, you know, your car, you drive it out, it depreciates. If you use it for business, you claim deduction for it. Depreciation on properties as investment properties has got some similarities. You get to claim the wear and tear on stuff. And we're a quantity surveyor. We estimate the cost of the building. We identify all the things in there that we can claim. And we put together what's called a depreciation schedule to give off to the accountant and work out what sort of deductions are available. So we visit the property, we identify these things, and we've done 700-something thousand of them in the last 20-something years. So and all over the country, you know. So it's been a good journey.
Mm.
Nice. And in terms of, I do have a question for you, Brad. What are the benefits of using the depreciation or getting a depreciation schedule?
Well, I mean, the simple benefit is cash. You know, we're all investing in, well, those that are investing in property. I'm a property investor. I do that absolutely to make money. That's the reason. And look, you make that money through your capital growth over time by choosing the properties you want, and also by the cash flow, the rent you collect. You've got expenses, etc. Depreciation is a tax deduction against that wear and tear. That just means, you know, we calculate a number. It's a deduction that an investor gets to make. We try to make it as much as possible, and the more it is, the more cash you actually get. So it's just a piece of that cash flow part of investing in property that many people don't really understand or do. And so hopefully we change that by busting the myth of depreciation.
Yeah. And so, Brad, how can a buyer ensure they're making the most out of depreciation?
Look, before buying an investment property, I think it's pretty important to really crunch the numbers. So now people come to us after they go to their accountant next year to do a tax return and say, I've bought this property, I'm going to make heaps of money, you know, a depreciation schedule, what's one of those? And I'm a believer in, before I buy something, I actually should crunch those numbers and know what it will actually cost me out of my pocket to own that property. And, you know, that one of those numbers that's sort of needed at the start to crunch all those numbers is a depreciation, must guess, estimate. How much would it get? And it's pretty easy. Like, we've got calculators online that you can go in and estimate put some information about the property you think about buying, and it spits you out some rough numbers, and apps that can help you even do the calculations and PropCalc as well. So
Yeah, I've seen it. It's great.
Just make sure they get it.
Yeah.
That's really the thing. Think about it before you buy. The important time is to really do it when you do go to do that tax return, because that's when you need to have the numbers for your accountant. But you know, just making sure they take advantage of it properly is the important thing, like so many have, but lots still don't.
Yeah, so when we buy for clients, we ask them to get a depreciation schedule, you know, in that first month or so.
Yeah, people, like from all of our numbers, people take about 10 months on median from settlement to buy a depreciation schedule from us. We sort of track and work out those numbers because some people do it straight away, some people do it 3 years later, which I mean, does have a little silver lining. You can back claim for 2 years if you've been missing out, but wouldn't you rather the money in your pocket when you could have it rather than getting it later? But at least you can kind of fix a bit of it, I suppose. But yeah, they do it at all different times depending on their level of knowledge all the time, I suppose. And also questions around whether they think they can and all that sort of stuff. They just often don't know.
Yeah.
And Brad, I guess one of the confusing areas, and sometimes clients hesitate to get a depreciation schedule, is that whole debate around new versus old property. And so there's always that perception that, you know, if I'm buying that classic, you know, 1960s, 1970s block, there's just nothing in it to depreciate. And is that true, or is that just a myth?
Well, I mean, it may be true and it may not be true, but because it depends on a few other things than just the age. And I think the best thing to do is I say, don't worry about age.
I don't.
In saying that, look, the simple, like if I tell you there's nothing there, it's because of the age and some other factors. And sometimes there's nothing there. But new property gets the most depreciation because just think like a car. The new car depreciates the most near the start because it's new, and new stuff, it's worth more at the start. It costs more to build, and therefore there's more depreciation in it. If it's old, it doesn't mean there's nothing there. There's just less there. Now, how old it is impacts on that, and renovation and works that have been done to that property impact on that. And the thing is that they changed a bit of legislation, you know, in 2017, which made it even a little bit more difficult to the age question. So I say, look, at the start, use the calculators and work it out, or give us a call and tell us about the property and we'll talk to you about it. But, you know that the new one gets more, and when you're crunching your numbers, you can, you know, work that out from the calculators. But don't ever say, oh, it's too old, I won't get anything. Say, well, it's a bit old. Old property still old property still gets depreciation. It doesn't get as much, but it's still there. It's still cash, and we don't do it unless we think you're going to get some money from it. Like, we can have a look at we ask a few more questions. We go, yes, we're going to get plenty of money, or no, it's not worth it. If I tell you it's not worth it, it's not worth it. But otherwise, don't listen to the guy at the pub.
or the Uber driver.
Or the Uber driver, that's right.
Yeah.
Or pretty much everybody at the barbecue on the weekend, unless it's me, once again, or one of my guys. It's something that we've really, I don't think it's battled, but spent a lot of time educating on, and I have in, you know, 20-something years, let's just go really simple. Old property still gets deductions. Call, ask the question. No quantity surveyor should do anything on it and charge you unless there's going to be deductions there. And they should be able to work that out before they actually go through the whole process. Plenty of photos of properties these days. It's pretty easy to work out of whether it's actually worth going through it before you do it. So there's no fear of spending something and not getting anything back, because we work that out before we actually go and spend your money.
Yeah.
Yeah, and it's interesting that you mentioned renos. Obviously, a lot of the older blocks are slowly getting renovated, and as the rental market, you know, it becomes tougher because it's competing against all that new stock, and so the investors kind of almost forced to upgrade, whether it's, you know, the white goods, the kitchen, or the bathroom, or they're doing a full scope of work. I guess it's one of the pieces of the puzzles. They tend to forget, because they're really leaving some change on the table if they're not getting a schedule done. And that's before and after, Brad, I believe.
Yeah, look, once again, when you've purchased, and a few things come into this, but if you are at the right times, there's a thing to consider before, where items that you do throw away that still had some value left, might be able to be scrapped or thrown, or when they're gotten rid of at the start, they're scrapped and instantly claimed whatever value is still left on that item. And then obviously the new items you put in, you spend money on those things and you get to claim on those things. But like the tip here really is, before you rip it apart, make sure you call the quantity surveyor and ask and see if there's anything there that might be worth something. And sometimes there is, sometimes there isn't. And there's a few more questions we ask about when you bought the property to identify that. But there's often money in what you're throwing away, because if you choose to throw something away while it's still working and you were still claiming depreciation on it, you've thrown the rest of the value away. So you get to claim it all in that year. If there's any value left and it meets the right criteria. So, you know, before you do it, call the quantity surveyor, and then after we can fix up with the costs that you've done to get both take advantage of all of that stuff. It's really easy.
Yeah. Okay. Well, I really need to talk about the thing that gets me going, which is all those misinformed buyers who pursue a negatively geared so-called buying strategy, and they get sold on depreciation. But when they're buying, or actually, you know, being hard sold into a property, the person that's doing the selling never tells them that when they sell the property, they have to pay that depreciation back.
Well, look, I'm the depreciation guy, and I don't think necessarily that negative gearing is a strategy. No. I think that the taxes shouldn't be the driver behind your purchase. You're purchasing property to make money, and making money means a lot of things. And taxation is one thing that changes the cash flow. Depreciation changes the cash flow, but you don't go and just buy stuff because it's got heaps of depreciation, because of multiple reasons, because capital growth, the capital value increases are important too. But what you're referring to there is like in relation to paying it back, which is not quite the right term. But at the end of the time, when you do sell a property, the claims that you make, or some of the claims you make, actually reduce the cost base. So when you do pay capital gains tax at the end, if you make a gain on the property, which is what we try to do, of course, some of the claims you make on the way through, you will add to your capital gains tax bill at the end. Now, on the way through, you get the money in your pocket as you do it, and you get to make these claims at your full marginal tax rate. When you pay capital gains tax at a later date, obviously it is a later date, so you've got the time value of money benefit, but you've also, capital gains tax is, you pay it at half your marginal rate. So when you calculate it, claiming the depreciation on the way through does end up with a little bit more money most of the time. We've run those calcs in the Maverick before. We've got case studies on that. But it's something that people don't say when they are selling the property that has lots of depreciation, absolutely. And as an investor, we should get informed about how we're doing everything in relation to that. And at the end go, well, I bought it for 500, I sold it for $1 million, I make 500. It's not quite that simple. There's taxes and things involved and things on the way. Depreciation is just one little part of the overall knowledge that you really should have before you invest in property. And what you can to learn about these things. And capital gains tax, they're a very good issue to make sure that investors do understand. And often they don't. So many investors in this country actually only buy one investment property. And I think it's a good strategy to create some wealth, I believe, if it's done the right way. And one is not necessarily the answer to that. But they don't really understand some of the things they probably need to when they do it at the start. And I think it's very important. I've done that over the years when I've bought properties myself, absolutely.
Yes.
I do have one.
Buy and hold it, Deborah. So CGT is a later problem for me, right?
Yeah.
I did have another question, Brad, for you. In terms of like, because I mean, with the depreciation schedule, the value of items in the property need to be identified. Just out of curiosity, how much work or effort is that for someone who's wanting to get that depreciation schedule done? How much work is it for them to identify all the costs or the value of everything that's in the property? Because I'm assuming it could be a bit daunting maybe for someone who's potentially thinking about doing a depreciation schedule, like working out how much the blinds are, the fixtures and fittings, stuff like that.
Well, the idea is they don't need to do that because we do it.
Nice.
So, I mean, the good point is, Ken, don't do a DIY depreciation schedule, because unfortunately, or fortunately, whatever you want to call it, you don't know the rules. You don't know what you can and can't claim. And the reason we as quantity surveyors actually get involved in this is that the claims actually relate to a claim against the construction cost at the time the house was built, and a value on those items that you talk about there, like the stoves and curtains and things like that. Now, the tax office has a ruling that says, where you don't have all of the actual costs available, that they'll accept costs estimated by a relevant professional, such as a quantity surveyor. And that's the actual wording from the legislation. And so it's a compliance issue. It's also, so we know the rules better and know what you can claim and know how to get the most out of it, which is how you get more money. But on top of that, the tax office, there's a compliance piece. If you go and tell the tax office you're going to claim based on your $1 million construction cost, when I know it's only 500, you get audited, you'll be in trouble. If I put $1 million on it, the tax office will go, okay, quantity surveyor. What they normally, their expertise is to measure and estimate construction cost of buildings, so we'll accept that cost. Doesn't mean they don't challenge it now and then, but we've got to provide them some backup, and we do that sometimes. But you know, if the numbers are high, they may ask questions. We answer the questions with back the reports. We know how to count bricks and estimate the cost of them. That's our expertise. We've got to know that with the tax rules and make sure that we do reports that do stack. We've done over 700,000 of them, as I said, and we get a few questions about them from the ATO, and we answer them quickly. And we go back with the supporting information. I haven't had one thrown out yet. So they get audited. Clients come to us when they're getting audited to fix up the dodgy claims or the incorrect claims they may have made. And we're very comfortable doing it when they've been audited, because usually when they've estimated something themselves or done a DIY, they've got less deductions than we have when we go and do it properly. So we sort of help to fix mistakes that might have been there otherwise, I suppose, a lot of the time by doing it properly. So I don't know, like everyone, you know, puts all their receipts for everything they ever buy in to make sure they claim at tax time, right? It's like a national sport, making sure you get your tax deduction, but they forget about depreciation for some reason a lot of the time. So, you know, don't do DIY. That's the answer, Ken.
All right.
We go out, we visit the property, we've got things to do, we go through, we identify, we have a look at the quality of the finishes and everything, and we estimate the costs and come up with this depreciation schedules, get it off the accountant, and help them make the tax deductions they should. So we don't want to leave them on the table with tax office. I don't like the way they spend it so much. So let's spend it ourselves, right?
Yeah, exactly.
Right. You've always said tax is not a very sexy subject to talk about. But is there any? I'm sure you collect quite a lot of data around, you know, what you guys do. Is there any interesting, you know, sort of fun facts that have come out of that? Property investors
that you can talk
We've
about.
Done some. I mean, it's not very sexy, right, John? But it is money, right? So let's just run with that. Love more money? Well, let's run with the money. Okay. What probably I don't know if it's interesting or disappointing. Like about 70. We've run some campaigns on let's have a look at what you're claiming, right? Look at what you're claiming, see if there's any more there, because you can go back and adjust 2 years of your tax return if you haven't been doing it properly. When we've done that, people have sent things in and said, I've got 17 Smith Street, I'm claiming $3,000, whatever. We have a look at it and say, well, it should be $6,000 or so. Maybe we should go ahead and do a depreciation schedule for you. About between 70 and 80% of people are missing out on deductions on the ones that we looked at over time.
There's a headline.
So even if you've got a depreciation schedule from another company, you could have a look at it and just see if there's any more meat in it.
Well, also we just have a look at, like often someone guesses or does a DIY or just, and sometimes like it's not about the other company's depreciation schedule, although we do have some pretty bad ones I see. It's more we're looking at the total deduction that's been claimed. Quantity surveyors are people who know how to estimate construction costs. To do it, so they're recognised to come up with those costs, but often they don't go and actually learn all the tax rules properly to make sure they apply and get everything from that. So sometimes a quantity surveyor can do a depreciation schedule and they don't know the rules or use the right software to apply all the rules properly, which is actually quite difficult and expensive. I need tax people and quantity surveyor people. I understand both, but I'm not an accountant. Our industry sometimes doesn't marry those two things together as good as it probably should, which is, I mean, it's probably why we do about half of them in the country, I suppose, because there is some ones that aren't done very well, and they might be cheap, but they're a bit nasty sometimes, right? So it's just important to get it done properly, I suppose. And we try to have a look at it without, you know, stepping on any toes anywhere, I suppose. We have a look and see if there's money there or not to be claimed. And if you're thorough, you'll get the most deductions. Like if you don't go to site and think you'll just do it off the data you can see, or the photos, or half the photos, you'll miss things. So we believe in a site inspection because we go through and we find everything, we have a look at everything, and I'm not scared to put the numbers on it then, because I'll back it. I've been there, I was there on this date. We know it's there. We know how much it should have cost to build. We don't have fear then because we've collected the information ourselves. So yeah. Anyway,
I'm sure you've seen a few accountants' reports come across your desk, and
I see
a few eye openers. Yeah.
Yeah, I see them just applying a percentage to the purchase price before. I see them not do common areas because they couldn't be bothered. You get to claim your part of the common areas. Why wouldn't you? It's like trying to save a few $100 and leaving a few thousand at the tax office for the federal government to spend. It just doesn't make sense to me sometimes. But, you know, that's the way it goes. That's why we're out educating, right? And talking to people about making sure it's done properly.
Right.
Yeah.
All part of the fun.
And so thanks very much for your insights, Brad. Really, really appreciate it. If people want more information, can they just go to your website? What's the best way?
Yeah, look, website bmtqs.com.au is very easy. Where, you know, Googling BMT finds us pretty easy as well, or tax depreciation. And the guy, we're very happy to have discussions over the phone about it with anybody. We've got real people sitting there on the talk about depreciation all day. So you don't have to just go to the website. You can call local office and have a discussion about the property and see if we can save you some money. It's really simple.
Sounds good. Alrighty. Well, thanks very much for watching. That's it for us for this episode. If you want more information from any of us, you can find John at realpropertymanager.com.au and Ken at Avvora.com.au and me at Debra at thepropertyfrontline.com.au. So thanks very much.
Brad, thank you very much for coming along.
Right, thanks, guys.
All right.
All the best to you.